This map tracks global steel trade flows, and it reveals a massive imbalance. Global steelmaking capacity has reached a 640 million metric ton surplus. China accounts for the largest share of that excess. Facing contracting domestic demand, Chinese producers exported a record 131 million tons of steel in 2025. With Western markets erecting high tariff walls, that volume is redirecting heavily into the Middle East. Chinese steel companies receive heavy state backing, with the median firm drawing 15 times more in subsidies relative to its assets than international competitors. At those rates, Chinese producers can export at prices that do not reflect true production costs. To bypass existing trade defenses, these producers are also rerouting semi-finished steel through third countries. Shipments flow into Southeast Asia, undergo minor physical modifications, and are then re-exported, making it nearly impossible for customs authorities to track the true origin. This influx of subsidized steel now functions as a permanent structural condition for every manufacturer operating within the GCC. This aggressive redirection actively pits large primary steel producers against downstream small to medium fabricators, effectively fracturing the entire local supply chain. Surviving this environment requires mapping the hidden choke points in the GCC's supply network, navigating the complex rules of local content policies, and weaponizing green technology to build a durable cost advantage. This flowchart maps the structure of the GCC steel economy. It starts at Node A with maritime inputs, feeds into Node B with primary mills, passes to Node C for downstream fabricators, and ends at Node D with end procurement. Looking closely at the primary mills, Gulf steelmakers operate direct reduced iron, or DRI facilities, alongside electric arc furnaces, known as EF. These specific technologies require a constant, high-volume supply of high-grade seaborne iron ore pellets, creating a localized supply chain vulnerability. In early 2026, an escalation of conflict disrupted commercial shipping through the Strait of Hormuz. That closure instantly severed the main maritime channel for both Chinese steel and those vital iron ore inputs. Local mills were immediately starved of pellets. Major entities like Fuloth Holding, the parent company of Bahrain Steel, were forced to declare force majeure and halt delivery commitments. A secondary shockwave hit logistics. Container freight rates from India to the UAE climbed from $300 to over $3,500, while rates from China spiked towards $7,000. Regional mills scrambled to replace seaborne pellets with local ferrous scrap. This intense domestic demand drove Saudi scrap and rebar prices to the highest levels ever recorded. The 2026 shipping crisis proved that relying on maritime corridors for raw material inputs is a single point of failure for GCC heavy industry. This chart illustrates the extreme price discrepancy facing Gulf buyers. Subsidized Chinese rebar exports price at roughly $480 per ton. Meanwhile, domestic UAE pricing sits at $741. No amount of local operational efficiency can close a price gap of over $260 per ton. To protect the balance sheets of primary, integrated producers, trade authorities typically respond by imposing anti-dumping duties on imported steel. While tariffs shield the large mills, they raise the raw material costs for downstream fabricators who rely on cheap imported coil and billet to keep project costs down. These smaller operations are caught in an economic trap. They must buy expensive, tariff-protected domestic steel, yet they still compete against imported finished metal goods that bypass those exact tariffs. For downstream fabricators, survival requires an immediate response. Any open contract signed before the 2026 freight spikes are likely loss-making and must be repriced or renegotiated before the next project cycle. Standard protective tariffs act as a blunt instrument. They save upstream primary producers while compressing the profit margins of the downstream SME sector. Governments deploy another policy mechanism to bypass cheap imports: domestic procurement frameworks, such as the UAE's In-Country Value Program and Saudi Arabia's mandatory list. Securing a high local content score essentially guarantees a government contract, even if a competitor relying on cheap imported steel submits a lower financial bid. This diagram breaks down the Dubai ICV formula. A company's score is weighted by local manufacturing at 55%, with Emirati ownership, parent domicile, and Emiratization each accounting for 15%. To earn these scores, companies must pass annual audits that track every detail of their local spending, asset depreciation, and workforce development. For smaller industrial firms, the administrative overhead required to manage these audits acts as a hard barrier to entry, often locking them out of the protected markets they manufacture for. The administrative gatekeeping of local content policies creates a paradox where government protection primarily benefits the large corporations equipped to fund dedicated compliance departments. We can apply 3 structural fixes to this system map to resolve these vulnerabilities. First, GCC countries should establish a unified trade defense office to coordinate import monitoring and prevent rerouted Chinese steel from slipping through the weakest regional border. Second, Gulf steelmakers must build regional scrap metal recycling networks. This secures a stable domestic ferrous input and eliminates the total reliance on the Strait of Hormuz. Third, instead of blanket tariffs, governments should deploy targeted operational support directly to SMEs, specifically energy discounts and reduced rents, to relieve their margin squeeze. These policy updates stabilize the immediate supply chain crisis, but they do not neutralize the long-term threat of subsidized Chinese volume. The defining market force of the next decade is carbon regulation, led by the enforcement of the EU Carbon Border Adjustment Mechanism. This curve plots global steel emissions. Because GCC producers rely on gas-based DRI and EAF technology, they sit right here at the low-emission trough. In contrast, Chinese coal-fired blast furnaces sit at the high-emission peak. When global carbon tariffs are applied at international borders, the price advantage of high-emission Chinese steel instantly evaporates. Regional producers are committing billions in capital to extend this lead, building hydrogen-ready green steel plants and deploying industrial-scale carbon capture. To justify these massive green investments today, GCC governments should update local content formulas to heavily weight carbon intensity, creating a captive domestic market for low-emission steel. The strategic task for policymakers is building the exact supply chain and workforce depth required to dominate a carbon-priced global market. The investment decisions made by Gulf governments and primary producers between 2025 and 2028 will permanently dictate whether the GCC is a leading supplier or simply a bystander in the next decade of global trade.